to you. Today is Tuesday, 24th of March 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. So, yesterday was about scale and founder dependency, and today is where the board, executive teams, and founders get an even less comfortable message, if you may, because revenue growth does not make a company stronger on its own. So let me pull up the model that we are discussing. So this is a full ecosystem, so it's the advisory board operating system. Yesterday we talked about scale, which is a commercial acceleration, and what implies the brand, the people, and the partnerships. And today we are going to talk about predictability. It also involves the partnerships, the revenues, and the assets. So it's the growth and the capital. So how predictable that growth and that capital is allocated to help that predictability, right? Okay, so having the model in front of us, so we know where we are stepping through this live stream today. Let's put it this way: a company gets stronger when growth is repeatable, right? That's why we mentioned predictability. So margins are defended, capital is allocated on purpose, and the board, the executive, and the founders knows which assets deserves more funding and which deserve less funding. And here's an example that I mentioned last week that I'm going to bring it back again. In '97, when Steve Jobs, the founder of Apple, was brought back to the company, because if you remember correctly, the board pushed him away and then called him in when they were in trouble. One of the first things that he done was to reduce 70% of the production line. That was around 210 products. So that's when we say which assets deserve more funding and which deserve less, or completely disregard them. This is what I'm talking about, because Jobs' vision was not about competing peer to peer, item by to item, device by device. He was looking into what is the assets that we can charge premium, right? So what are the premium, what makes our brand, our revenues, and our distributions and partnerships more stronger, our IPs more stronger, more valuable, and more predictable in the future. So this is all about these sections. And I think that a perfect example is that one. And you might say, well, Steve Jobs, Apple is a different story. It applies. It's a formula. This is what I want you to, if you want to grab something today, remember that all these things have been studied to exhaustion. So people now understand that actually there are certain templates that are repeatable regardless of the size and industry you are. So this is where I come in as a board advisor. I build a rotation international advisory board around the live milestone that you are setting in these cases. So the board, the executive team, and the founders get the right mix of capital, pricing, portfolio, and integration expertise faster than hiring one stellar executive without the consulting bloat, and without being stuck with the wrong specialist 6 months later. Because sometimes you hire the right person, right expertise, right experience for a very specific problem. What you're going to do with that person 1 year down the line. Right. Okay. So let's start to develop this model, this section of the model, which is predictability. And I'm going to mention 3 problems. Number 1 is, we have to name this clearly. It's called the advantage paradox. It's the idea that more revenue creates more ways to lose money, right? Because actually it's like a bucket that you fill, but it's full of holes. And this is because the organization is rich but lacks permanent advantage assets. And what I mentioned here is, for example, back to the Steve Jobs example. So you are competing one-to-one to the next competitor. And now with the borders, international borders are so flexible. Look what happened with the fashion industry. So the shops in Main Street, particularly clothing, are closing because it's much faster, much cheaper, and much choices, if you may, and more comfort to buy from an online retailer that is shipping from China directly from the factory to the end consumer than actually having a shop with all the infrastructure, investment, etc., that requires. So that's what I mentioned, the advantage of the assets. This is a milestone to set in the organization. If the board, executive teams, and founders does not impose capital discipline, it builds a money trap. You can still be generating revenues, but it's still trapped in a circle that it seems to be that you never get out of it. The second problem is the UK backdrop that makes all this more dangerous. So the British Business Bank says that smaller businesses invest less than larger businesses in the relative turnover, right? So the higher turnover, more investor, more small turnover, less investment. And that business investment has historically been low anyway. So the high cost of credit and risk aversion are key reasons here. So fewer smaller businesses are using external finance. And you may say, well, that's usually the thing because people are bootstrapping. But the key question here is, are you bootstrapping on the right things, right? So some statistics to support this. I'm actually going to wrap up why these statistics are important. So this is problem number 3. The demand side is hardly generous either. So you have not a big demand. And the Bank of England in this month agent summary continues to report concerns over profitability and affordability alongside a relatively weak demand outlook, meaning that actually the people or the businesses are looking for funding, but the bank says, well, you're not profitable enough, you cannot afford this, and they are, in short, means actually they don't have a big demand. What that means is that there is enough money available. This is the thing. So actually, if you say, oh, I tried, I didn't get it, it's not because it's not available. This is a misconception that many people have. It's because the preparation to access that capital is not there. And this is a big challenge. Also, the Office of National Statistics says the annual net rate of return for private non-financial corporations remains at 10.3% in 2024. And these are the stats. So the board and executive teams and founders' questions, I think, is very simple. Where is the margin protection really coming from? And when you have that, then you start to see that actually capital availability is much flexible, right? But more flexible, I mean, actually is more available in terms of actually you have the capacity now to demonstrate. So why I mentioned these stats with the Bank of England and the National Statistics Office is because the message is very simple. It's not because the size of the business determines if you have access to capital or not. It's all about preparation. What are your assets? What are your revenues? And how you are to demonstrate that you have predictability in your business, right? In other words, so imagine as a board or executive team or a founder, you treat growth like a fill in a bucket, right? So the real job is checking for holes before pouring in more water. So this is what also the investor sees. I say you want more capital for a business that is leaking everywhere. So preparation again. So you put this together, and then you will see that capital is more friendly with your organization. So you may say, which is a real question here? So the question I would put here is very simple. Are we growing in a way that gives the board, the executive team, and the founders more confidence? Or are we simply getting bigger while the risks get harder to see, right? Because getting bigger means that you can go to market, sell more, have a bigger revenues, etc. But the risks are getting harder to see because the capital seems to be, or the cash flow seems to be sustaining the business very well, but effectively, potentially, you are not even making any profits. You are losing money. But it's disguised in this amount of cash flow that is going every day, every week, every month, etc., etc. So as a board advisor, what I would propose to consider is the following. Number one, and always I look through these things through assets. So look at your predictability through partnerships the revenues and your assets. So in terms of partnerships, ask whether growth is being accelerated through integration, channel leverage, and ecosystem expansions. And this is a very good example. It's in a public domain, so you can download it or study the paper that they, not the paper, what they produce in terms of the shareholders report is SAGE. And they report that their plan to 2027 is to have 97% of their, if the stats, if I remember it correctly, I think 97% of their annual recurring revenue coming from partnership and distributions, meaning all the ecosystem that they built around their distribution of the selling of the software, right? And as up to last year, I think that they achieved around close to 90% of that, right? The plan started 3 years ago, and the aim is 2027 to have 97% of the revenues and the recurring revenues coming through their ecosystem and partnerships. That's why it's so important this. And I say, well, but we don't have that kind of infrastructure. They planned it for 5 years. This is not something actually, it's a 5-year plan. It's not something that you're going to snap your fingers and going to happen. So also is the reality of your business. You have to study what you're doing, how you do it, and then say how we can multiply our effort through distribution, channel, ecosystems of resellers, etc., etc. In terms of revenue, ask whether pricing and margin discipline are strong enough to defend returns, right? So this is also implying what are the partnerships and distributions that you have. And in terms of the assets, the things that you are intangible or tangible, ask whether capital is funding the high intensity opportunities or quietly carrying passengers, meaning that actually you are funding something that actually, like the Steve Jobs case, 210 products that actually you are a production line, 70% of your production line pretty much is sustaining a system that actually is spinning the wheels, right? So using the model that you have in the screen here, an advisory board operating system, this ties predictability to portfolio optimization and asset intensity close to an A-grade asset or a premium asset, like the example of Steve Jobs and Apple. Now, the second thing to consider is the practical moves are useful because they are not vague. They are a framework for strategic integration, pricing and margin optimization, and portfolio stewardships. But put it plainly, that means that map the asset base, grade it, and stop funding things that are drifting, and price with evidence rather than fear. And fear means actually this, back to the example of Apple. Fears means actually we cannot discontinue 210 products. It's 70% of our production line. So the evidence showed that actually the decision was correct, but the fear kept that production going. So that's the logic, the goal, and the business outcome. Value increases as companies become more predictable and financially understandable. And understandable, I mean, from the side of your stockholders, your rounds of capital, investors, and institutions. And number 3, just make sure that when capital is scarce and strategic, the boards, executive teams, and funders cannot afford to be lazy about asset allocation. And again, this is the perception of scarcity is because they say you probably went to your local bank or to where you have your relationships, or you went to your investors, or you went to your stockholders and say, we are going to do a round, and they say no. So here's a big problem, and this is where I'm going to give you this suggestion. Be more strategic how you're going to go this round of raise of capital. So don't do it on things actually are spinning the wheels, doing things actually really produce a value and can be trackable. So all sounds right in theory, you may say, well, yeah, perfect, it's a good theory, but what does the board, executive team, and founders do when it needs the pricing discipline, the portfolio allocation of limited resources effectively, and capital clarity? This is in this quarter, not after another long review. So what is the right thing to do? This is where I come through and I help you. and you gain three things working with me in terms of outcome, differentiators, and risk reduction. I'm going to explain them very quickly. In terms of outcomes, I build a rotating international advisory board around these growth capital milestones, so bringing together the exact mix of pricing, portfolio, capital, and commercial integration capability that the board, executive team, and the founders needs now. So the result is a faster path to investor-grade predictability without waiting for a single senior hire to cover every single gap, and potentially 6 months or 1 year later, the person says what I'm doing in this organization, because my use is not here anymore. In terms of differentiator, I do not sell growth theater. I install a board operating system and a rhythm like the graph that you have in front of you. So we have a full view of what's going on every day, every time, instead of a tunnel of funnel vision that actually is the day-to-day operation of what had to be done today to keep going or keep running the business. That means capital discipline, asset grading, pricing review, partnership logic, and a decision cadence that makes financial performance easier to understand, defend, and communicate it to the market. So your proposal is explicit that investors' price risk is lower, and is not something that actually they saw is another model for the next 3 years, for the next 5 years. Is a very predictable investment plan. In terms of risk reduction, the expert teams remains modular. What I mean this is actually we can bring people and replace people as the projects evolve to higher complexity or different complexities. Like, if, for example, look what happened in the past 3 weeks with the Gulf, in the Gulf, Arabic Gulf problems that they are there, right? The whole geopolitical things change in 3 weeks, and now what say, well, this is not impacting me because actually I'm a local in my country and I don't go cross border. But the price of petrol increased by 20 cents or more, or 20 pence. So it's impacting you, believe it or not. So how that is affecting your budgets this year or this quarter or this next month. So that's where members are swapped every 6 months or when we need it, as the company moves from one milestone to the next one. So the board, executive team, and the founders avoid talent locked in or over hiring too early and paying for board advice when the real issue is a handful of hard commercial decisions. Now, one action you can take home today, and is doable in 30 minutes or less: list your top 10 uses of capital, and then mark each one as A grade, B grade, or a drag. Remember the Apple case when they discontinued 70% of their production line, and then base them on terms of margin, contribution, cash conversion, and strategic relevance. And there, probably you're going to start to have a better view what's going on in your organization. So let's pause it here for today and reconvene tomorrow. Tomorrow, I will move into control and resilience, because once the board can see where value is being created, the next questions gets sharper. Why does delivery still rely on heroic efforts to protect it, meaning spinning the wheels? Now, if you are a board member, executive team, a chair, non-executive director, or a founder, and you need to make growth more predictable through stronger pricing, clearer capital discipline, and better portfolio decisions, set up a 30-minute call so I can understand your position now, so we can build a rotating international advisory board around these milestones, so you can get exact expertise needed for a faster turnaround, rather than hiring one executive without a consulting overhead and without a talent locked in that sometimes these carry together. So have a great day, and I'll